Let's start at the beginning here. You host a nationally televised cable money program. When did you first get interested in finance?
Well, when I had trouble balancing my checkbook during college, I had no money. I was on scholarship and didn't even bother really kind of taking the time to figure out how much money was in my bank account because it was usually under $25. And I looked around at the other students and realized that there was a certain power that came from money, and that if I were to be able to manage my finances, that I wouldn't have to think about them. That was a key. That was key for me. I didn't want to spend my whole time thinking about money.
You know, it's a sad fact, but whether you're in college or out, life without any money is not fun.
Exactly, and that's why I think that young people really need to start thinking about investing at an early age. Not so much because they're greedy or money-grubbing or a capitalist pig, but more because you need to put your money to work so you won't have to think and worry about it. These days, in order to get ahead in the world and to ensure that you and your family enjoy a good education or a comfortable retirement, you need to make your money work even harder than you do. So that was my first introduction to money, and I've made almost every personal finance mistake in the book, which is why hopefully I can talk to people about, correcting their own situations.
You know, Brenda, for people just starting out in the markets, we hear, as you know, one mantra: mutual fund, mutual fund, mutual fund. What's the deal on that?
There's a reason that mutual funds are as popular as they are, and that is because they offer convenience and they offer diversification, and they also offer an introduction to the whole world of finance. When you first initially invest in a mutual fund, whether it's as low a sum as $500, you really have to do your homework and figure out what the manager is doing and why he's doing it at reasonably low risk to your principal investment. So, I think that you can start investing in a mutual fund and watch what happens to your money during college with some of your savings. And even if you lose money, it's at that point that those are good lessons to learn rather than when you're making and investing a lot more.
Brenda, so many mutual funds out there. Am I correct in saying that people really need to do their homework before they kind of just toss their money into the market?
Absolutely. You can't just throw your money at a fund and then expect it to return dividends to you. You have to first check out and ask yourself some key questions. What is your risk tolerance? What is your time horizon? What do you need this money for? And once you've answered those questions, you can then figure out what type of sector fund or if an index fund makes sense for you. And then you really do need to look at the manager's history, at his or her own approach to dealing with your money. You have to read the prospectus. It sounds like a lot more work than it actually is. It doesn't really take that much time, but it pays off.
It seems that in recent years, the trend has turned towards owning mutual funds as opposed to individual stocks. How has this changed the overall character of the market?
Well, that's a great question. It has changed not only our own opportunities, but it's changed the whole nature of the market and of Wall Street. In my opinion, Wall Street no longer belongs to white men in blue suits. I think there's some 47 million Americans own stocks, and people who are pouring money into their retirement funds and savings for college have become a key prop to the market.
We hear about people trading mutual funds like individual stocks. Am I correct in saying that, for the most part, mutual funds should be viewed as a long-term investment?
Absolutely. We had a big debate on this show whether or not we should give mutual fund returns on a daily basis, and we decided not to. And we also decided against having a mutual fund ticker on the show because people tend to just watch whether or not their fund is up or down and then sell on that information, when in reality they should be asking themselves questions about whether or not the reasons they chose that investment are still intact, not whether or not it's up or down a dollar.
Brenda, a lot of my contemporaries are going to be getting a lump sum in the near future. Perhaps mom and dad are going to give you like a little graduation gift, or grandma's going to raid the piggy bank or something. What's a strategy for dealing with that, with a wad of cash kind of thrust on you at one time?
Well, the best strategy for people in that scenario, actually people in almost any scenario who have money that they want to put into the market, is to dollar cost average. And basically what that means is putting a fixed amount of money into your particular investment every month. And what you're doing is evening out the ups and downs of the market. So you're not just throwing it all into the market at a time when it's very high or very low. And it also forces a certain discipline on you. A lot of people viewed this last week when we had some trouble with the market as a buying opportunity. And that very well may be the case, but it's difficult to throw your money at something that looks like it's heading south. So dollar cost averaging forces you to buy at times when the market is lower.
As I've mentioned many times on the program before, I am a major CNBC junkie. I mean, you got Brenda Buttner, you got Bill Griffith, you had Neil Cavuto, you got Maria Bartiromo, you got Ron Insana, terrific broadcasters. Tell me what it's like to work at CNBC.
Well, it's a lot of fun. I mean, they're very intelligent people, and we're getting paid to talk to interesting people about interesting issues. As with any newsroom, there's a lot of daily pressure to get to break the news and to get it right. But I think that's fun too. I mean, I think that kind of extra pressure makes you perform a little bit better. So I've really enjoyed my time here.
Brenda, out of all the movers and shakers and legends you've interviewed on the Money Club, who's your favorite guest?
We had a guest on a couple of weeks, Mark Mobius, who is
the Templeton Funds,
yes,
right?
Exactly. And the reason I so enjoyed talking with him was that he was just completely down to earth. I mean, he may be managing billions of dollars, but he really thinks that the same techniques that he used can be used by small investors everywhere. So that was just a particularly fun interview. I also love to get the people that call into our show are probably my greatest inspiration. I mean, they teach me a lot, so we enjoy talking with them too.
We hear a lot about the loss of Social Security and the downsizing and wage cuts. Looking forward, is your forecast for my generation that bleak?
Yeah, that's a really good question too. We probably can't depend on Social Security. We probably can't depend on our pensions to pay for our retirement. But one thing that I always try to bring up when we have this bleak discussion is that the whole talk of money doesn't have to be depressing. I mean, you're saving for reasons. You're saving because someday you're going to have a kid who, plays baseball and goes to college. You're saving so that when you retire, you can, as I enjoy to do, ride my motorcycle. Or you're saving for really good reasons. And it flips, it's two sides to the coin. And the other side of saving is spending, and that's fun. So I don't think that. I mean, yes, we have to save aggressively, but it's not that difficult, and you're doing it for good reasons.
Your motorcycle?
Yeah.
You've got a bike. You've got like a big Harley.
Yes.
All right.
Yeah.
Excellent.
Yeah, lots of fun.
Brenda, you are a tremendous inspiration. We will continue to watch you nightly on the Money Club, seen nationwide on CNBC. And I cannot thank you enough for joining me this morning.
Oh, thanks so much. And great questions, too, from you. I appreciate it.